Welcome everyone, and thank you for joining us today. I'm excited to kick off this session with a focus on the certification programs scheduled for November 2025. Today, we'll be exploring the NISM Series VA, mutual fund distributors, along with the current investment landscape. Over the next few slides, we'll cover the key aspects of this certification, what it means for professionals in the field, and the trends shaping the investment environment. Let's get started and dive into what's ahead. Today, I want to talk about the fundamental purpose of investing, especially in the context of inflation. First, when we face inflation, one of our main goals is to preserve our purchasing power. This means making sure that the money we invest today doesn't lose its value over time. Next, we invest with our life goals in mind. Whether it's buying a home, funding education, or planning for retirement, investments should help us achieve these milestones. To do that effectively, we need to build a corpus. That is, a substantial amount of money that can support us in the future. We also need to consider future needs. As time goes on, our expenses and financial requirements evolve, so our investments should be aligned accordingly. Another key point is deferring consumption. Instead of spending all our income now, we invest it so that it can grow and be available when we truly need it in the future. All of these points highlight the purpose of investing. It's not just about growing wealth, but about planning smartly to meet our life's objectives, protect our financial stability, and ensure that inflation doesn't erode our savings over time. Let's take a closer look at the differences between active and passive approaches to managing your finances. When we talk about an active approach, we're referring to strategies that aim for higher returns by actively choosing investments. However, these often come with lower liquidity, meaning it can be harder to cash out when you need to, and they also tend to carry higher risk. On the other hand, a passive approach usually focuses on more stable, lower returns, but it offers higher liquidity, making it easier to access your funds when necessary. It also involves lower risk, which can be more suitable for those who prefer stability. It's important to understand that these two strategies serve different financial goals, whether you're looking to grow your wealth significantly or prioritize safety and easy access to your savings. When comparing savings versus investments, think about your risk tolerance, your timeline, and your overall financial objectives. Both approaches have their place, and choosing the right one depends on your individual situation and what you want to achieve with your money. Let's talk about why understanding inflation is essential if we want to make smart investment decisions. When we say investment imperative, we're emphasizing that it's crucial to look beyond just the nominal return, what our investments earn in dollar terms. Instead, we need to subtract the inflation rate to see the real growth of our money. This is what we call the real rate of return. Think of it this way: your money might be increasing in nominal terms, but if inflation is high, the actual purchasing power of that money is shrinking. That's why money loses value over time if inflation isn't kept in check. It erodes what we call purchasing power, meaning what you can buy with your money decreases as inflation rises. So, the role of inflation in our overall financial picture is significant. It's not just about earning a high return, it's about earning a return that outpaces inflation. Otherwise, no matter how well your investments perform nominally, your wealth could be losing real value. Keeping this in mind helps us make better decisions to protect and grow our wealth in an inflationary environment. Let's take a closer look at the different types of investors. Starting with banks, these are major financial institutions that often invest on behalf of their clients or for their own portfolios. Insurance companies also play a significant role. They manage large pools of funds to meet future policyholder obligations. Moving on, mutual funds and pension funds are collective investment vehicles that pool money from many investors to build diversified portfolios, which helps reduce risk. Institutional investors, such as these, typically have considerable resources and influence in the markets. On the other hand, we have individual investors, also known as retail investors. These are everyday people investing their personal wealth, often through personal wealth management services. Retail investors tend to have smaller amounts of capital compared to institutions, but are just as important because they drive a significant portion of market activity. Understanding these different investor types is crucial because each has unique goals, strategies, and impacts on the financial markets. Recognizing who the investors are helps us see the broader picture of how capital flows and how market dynamics operate across various segments. Let's talk about some of the key investment objectives that can really help you meet your financial goals. First, ease of exit and fund accessibility are crucial. This means you can access your invested funds without hassle whenever you need them. Liquidity is an important factor here, ensuring that your money isn't locked away and you can respond to changing needs or opportunities. Next, we look at returns, which come in two main forms: yield and dividend returns. These provide you with regular income, helping to support your financial stability. On top of that, there's the growth of the principal amount. Over time, your investment can increase in value, contributing to your overall wealth. Finally, capital appreciation is about the potential for your investments to grow in value as markets perform well, which is essential for wealth accumulation over the long term. These objectives collectively help create a balanced approach, aligning with different financial aspirations and risk tolerances. They are all interconnected parts of a smart investment strategy designed to help you build and sustain wealth. When we talk about investing in equities, a key idea to keep in mind is that there's a balance between risk and reward. Essentially, the higher the potential reward, the higher the risk involved. This is what we call the risk-return profile. In the short term, stock prices can fluctuate quite a bit, which is known as volatility. These price swings can seem unpredictable, but over the long term, equities tend to offer higher returns compared to other asset classes. This growth potential makes them attractive for investors looking to build wealth over time. It's important to understand that investing in companies and businesses through equities gives you an ownership stake. This means you're essentially a part owner of the company, which can be quite rewarding if the company performs well. Since equities are classified as an asset class, they play a crucial role in diversification and portfolio growth. Remember, the higher the risk you're willing to take, the greater the potential for higher returns, especially over the long haul. Let's take a closer look at some of the key features of this investment option. It's characterized by stability and lower risk, making it an attractive choice for those who prioritize safety. The lower volatility means that the value of these investments tends to stay steady, which can help reduce anxiety during market fluctuations. Focusing on safety, this asset class aims to protect your capital, ensuring that your initial investment is preserved as much as possible. Along with that, it offers fixed interest income, providing predictable returns that you can count on over time. One of the main advantages is the reliability of returns, which come from lending to governments or corporations. This lending instrument falls under the debt asset class, making it a form of debt investment. Overall, this type of investment is designed to be a secure, income-generating option that fits well within a balanced portfolio, especially for those seeking stability and capital protection. Let's talk about physical assets, specifically real estate and gold, as part of your investment strategy. When you invest in real estate, you can generate rental income, which provides a steady cash flow. Additionally, real estate tends to appreciate over the long term, meaning its value can grow, helping to build wealth over time. Real estate is also considered a good hedge against inflation because, as prices rise, so do property values and rental incomes. It serves as a store of value, preserving your wealth through economic fluctuations. Plus, owning real estate can diversify your investment portfolio, reducing overall risk. Now, gold is another key asset class in this category. It's often seen as a safe haven during uncertain times. Gold and real estate both serve as inflation hedges, helping protect your wealth from erosion. They also act as a store of value, maintaining their worth over time. When we combine gold and real estate as an asset class, we create a balanced approach, diversifying your portfolio with tangible assets that have stood the test of time. This alignment with our overall theme highlights the importance of tangible assets in building resilience and long-term wealth. Let's talk about the capacity to absorb losses. This is really about understanding how much risk you can handle without feeling uncomfortable or jeopardizing your financial well-being. Your financial status plays a key role here because it influences how much loss you can realistically withstand. Now, moving on to the time horizon, the longer your investment period, the more risk you can generally take on. That's because, over time, markets tend to fluctuate, but there's a good chance they'll recover, allowing you to ride out the ups and downs. Your time horizon depends on factors like your age, income, and your goals. For example, a younger person saving for retirement might have decades to grow their investments, whereas someone nearing retirement might need a more cautious approach. This ties into your risk appetite, which is essentially how much risk you're comfortable taking. Generally, the higher your risk appetite, the higher the potential return you might achieve because you're willing to accept more volatility. And this brings us to a key point. There's a direct correlation between risk and return. The relationship is quite straightforward. Typically, the higher the risk you take, the greater the potential return, but it also means more chance of losing money. Understanding this risk and return relationship is central to making informed investment choices that align with your personal situation and goals. Understanding asset allocation is crucial because it helps you achieve your long-term financial goals. Think of it as a strategic tool that guides how you divide your investments across different asset classes. Now, while individual stock selection is important, it's actually less impactful than many assume. In fact, research shows that asset allocation determines about 80 to 90% of your portfolio's returns. That means making smart decisions about how much you invest in stocks, bonds, real estate, or other assets has a much bigger influence on your overall success than picking individual stocks. So, when we talk about understanding asset allocation, we're really focusing on how diversifying and balancing your investments can be the primary driver of your financial growth over the long term. It's all about setting the right foundation for your investment strategy. Now, let's take a closer look at the differences between strategic and tactical allocation. On the short-term side, we see terms like flexible, market-driven, opportunistic, and tactical. These are all approaches that are more reactive and adaptable to current market conditions. They allow us to shift our investments based on market opportunities or short-term trends. This approach is more about seizing immediate opportunities and adjusting quickly. In contrast, on the long-term side, we have fixed allocation, goal-based, buy and hold, and strategic. These are more about setting a plan and sticking to it over time. Strategic allocation involves establishing a long-term target mix based on our overall goals and risk tolerance, and then maintaining that mix through market ups and downs. The key difference here is that tactical allocation is more flexible and opportunistic, while strategic allocation is more fixed and goal-oriented. Both approaches have their place, but understanding when to apply each is crucial for effective investment management. Ultimately, integrating both strategies allows us to remain disciplined while also taking advantage of market opportunities when they arise, aligning with our overall investment objectives. When we talk about financial goals, it's really about setting clear objectives and specific timelines to achieve them. This helps us stay focused and measure progress along the way. Next, let's consider income stability. Some of us have a steady, predictable income, while others might have irregular earnings. Understanding this difference is crucial because it influences how we plan and allocate our investments. Then there's the time horizon, the length of time until we need to access our funds. A longer time horizon generally means we can afford to take on more equity exposure, since we have more time to ride out market fluctuations. Finally, risk tolerance. This is about how comfortable we are with taking risks. It's both our ability to withstand potential losses and our willingness to accept them. Knowing this helps us tailor our asset allocation to fit our personal comfort level. All of these factors, goals, income stability, time horizon, and risk tolerance, are key because they directly influence how we decide to allocate assets. They ensure our investment strategy aligns with our individual circumstances and overall financial plan. Let's talk about a common behavioral bias that influences many investors, following crowd decisions rather than relying on our own analysis. This tendency is often called herd behavior. Instead of making independent choices based on thorough research, people tend to follow what others are doing. It's like when everyone rushes to buy a stock because they see others doing it, even if they haven't fully evaluated the situation themselves. Now, this behavior can be driven by a fear of missing out or simply wanting to fit in with the crowd. But there's another powerful emotion at play here: fear of losses. Interestingly, the fear of losing money often outweighs the pleasure of making gains. This can lead investors to avoid risks altogether, even when taking calculated risks might be the smarter move. These two biases, loss aversion and herding, are closely linked. Loss aversion makes us more sensitive to potential losses, and herding makes us follow the crowd to avoid standing out or making a mistake on our own. Recognizing these biases is crucial because they can lead us to make decisions that aren't based on rational analysis, which can impact our investment outcomes. So, understanding these behavioral tendencies helps us become more aware of our own decision-making processes. Being mindful of herd behavior and loss aversion can help us make more balanced and informed investment choices, rather than simply reacting to the crowd or our emotions. All right, let's take a closer look at some common behavioral biases that can really influence our decision-making. First, we have confirmation bias. This is when we tend to seek out information that supports our existing beliefs, essentially filtering out anything that might challenge them. It's like having a mental tunnel vision that reinforces what we already think. Next, there's recency bias, which is the assumption that recent trends or events will continue into the future. We often give disproportionate weight to the latest information, thinking it's more relevant or accurate than older data. Both of these biases, confirmation bias and recency bias, are part of a broader set known as behavioral biases. They can distort our judgment and lead us to make decisions based on incomplete or skewed perspectives. Understanding these biases is crucial because they tie directly into the overall theme of our presentation, recognizing how our minds can sometimes mislead us, especially in financial or strategic decision-making. Being aware of these tendencies helps us to question our assumptions and strive for more balanced, rational choices. Let's talk about a common pitfall in investing: overestimating our ability to predict markets. Many of us tend to believe we can forecast market movements accurately, but the reality is, markets are incredibly complex and unpredictable. Overconfidence plays a big role here, making us overestimate our skills and knowledge. Another important concept is over-relying on the first piece of information we receive. This is known as anchoring. When we anchor, we tend to give disproportionate weight to initial data or impressions, which can skew our judgment later on. Both of these biases, anchoring and overconfidence, are part of a broader set of behavioral biases that influence our decision-making. Recognizing these biases is crucial because they can lead us to make poor investment choices, especially if we ignore the inherent uncertainties involved. Understanding these tendencies helps us become more aware of our limitations, and that's a key step toward making more rational, balanced decisions in the markets. Let's take a closer look at how market and interest rate risk are managed. These risks are primarily handled through asset allocation, which involves spreading investments across different asset classes to manage overall risk. It's important to understand that some risks, like management risk, cannot be diversified away, meaning no matter how diversified your portfolio is, certain risks remain. When it comes to the impact of interest rate risk, there's an inverse relationship with bond prices. So, when interest rates go up, bond prices tend to go down, and vice versa. This is a key concept because it shows how sensitive bonds are to changes in interest rates. Now, interest rate risk is a form of systematic risk, meaning it affects the entire market rather than just specific securities. This kind of risk can't be eliminated through diversification because it stems from broader economic factors that influence all investments. In summary, market risk and interest rate risk are interconnected, and understanding their dynamics helps us better manage our portfolios. Managing these risks through strategic asset allocation is essential for achieving our investment objectives while navigating the uncertainties of the market. Now, let's take a closer look at how these risks impact our debt instruments and overall investment strategy. First, we have credit risk, which essentially refers to the possibility that the borrower might default on their obligations. This risk directly affects the expected cash flows from our investments, since if a borrower fails to pay, our anticipated income stream is disrupted. It also influences our exit strategy, because if a borrower defaults or there's a high risk of default, it becomes more challenging to reposition or sell the asset at a fair price. Speaking of selling assets, liquidity risk comes into play here. Liquidity risk affects our ability to quickly sell assets without incurring significant losses. When combined with credit risk, it can make exiting a position more complicated, especially if we need to do so in a hurry or at a fair value. This is why understanding both liquidity and credit risks together is crucial. They directly influence how we manage our portfolios, especially when timing and fair pricing are critical. Overall, these risks highlight the importance of thorough risk assessment and management strategies, ensuring that we can navigate potential defaults and liquidity challenges to protect our investments and optimize returns. Let's talk about how diversification can help achieve smoother returns and lower volatility in our investments. Essentially, the outcome we're aiming for is not only higher returns, but more consistent ones over time. And a key principle here is, don't put all your eggs in one basket. By spreading your investments across different assets, you're reducing the risk associated with any single company or sector. This is what we call reducing unsystematic risk, which is the risk specific to individual companies or industries. The benefit of this approach is clear. By diversifying across various sectors and assets, you can better protect your portfolio from unexpected downturns. We refer to this approach as a diversification strategy, and it's foundational for managing risk effectively while working towards stable, long-term growth. Now, let's take a look at the two key phases of the life cycle and wealth management approach. First, we have the distribution phase. During this stage, the focus shifts towards safety and capital preservation. It's about protecting the wealth you've accumulated, so you want to be more cautious, with a higher allocation to debt instruments and other lower-risk investments. The goal here is to ensure your assets are preserved and can support your needs during retirement or other income requirements. Moving to the other side, we have the accumulation phase. This is where the focus is on growth. Here, we typically see a higher allocation to equities and other growth-oriented investments. The idea is to take advantage of a longer time horizon to build wealth, understanding that some volatility is acceptable as long as the overall growth aligns with your goals. These phases are part of the broader life cycle and wealth cycle, which help us tailor investment strategies to different stages of life. Recognizing where you are in this cycle allows us to optimize your portfolio for both growth and safety, aligning with your overall financial objectives. Building wealth really comes down to outpacing inflation over time. It's not just about saving money, but making sure your investments grow faster than the rate at which prices rise. That's why focusing on real returns, those after inflation, is so important. To achieve this, staying disciplined, rational, and consistent through all market cycles is key. Markets will have ups and downs, but if we stick to a steady plan, we're more likely to see long-term success. Controlling behavioral biases is another crucial factor. Our emotions and instincts can sometimes lead us astray, but recognizing and managing these biases helps us make better decisions over the long run. And of course, asset allocation is at the heart of building wealth. Choosing the right mix of assets tailored to your goals and risk tolerance helps optimize growth and manage risk effectively. So, in summary, the key takeaways are: focus on real returns, stay disciplined and rational, control our behavioral biases, and remember that asset allocation truly is the foundation of a successful investment strategy. These principles connect back to the overall idea of building sustainable wealth over time. When it comes to real estate, one thing to keep in mind is that it often involves high maintenance and transaction costs. These can add up and make investing more complex. Additionally, real estate is generally considered a high-risk, high-return asset class, meaning that while the potential for profit is significant, so is the risk involved. On the bright side, real estate investments can generate rental income, which provides a steady cash flow, and over the long term, property values tend to appreciate, offering capital gains. You have options here. You can invest directly in physical property or through financial instruments like REITs, which make investing in real estate more accessible and flexible. However, one of the key challenges is that real estate is not easily divisible. Unlike stocks, for example, you usually can't sell just a small part of a property. It's an all-or-nothing kind of investment. Plus, real estate is quite illiquid, meaning if you need to sell quickly, it can be tough to get a fair price because the market may not always move fast enough to meet your timing needs. Another important point to remember is that location plays a crucial role in determining a property's value and demand. A prime location can significantly boost your investment's potential, making property in desirable areas more attractive. In the context of India, real estate is considered an important and popular asset class among many investors. Its potential for appreciation and rental income makes it an appealing part of a diversified portfolio. But always weigh the high costs and liquidity considerations before jumping in. Let's talk about investors who might not invest throughout the entire year. We often call these seasonal investors because their involvement is sporadic. They typically don't have a lot of pre-planning, which means they usually take on higher risks but also have the potential for higher returns, often over a shorter time frame. These investors tend to make lump sum investments or redemptions, meaning they put in or take out a large amount of money at once. You'll often see them investing when markets are low, aiming to buy at a discount, and withdrawing when markets are high to lock in gains. Because their approach is more tactical, they adjust their allocations based on current market and economic conditions. This strategy is known as tactical or dynamic asset allocation, and it's all about being flexible and responsive to the market environment. This kind of strategy fits into the overall theme of active management, trying to optimize returns by timing and adjusting investments rather than sticking to a fixed plan. Now, let's look at the types of schemes that are exempted from this rebalancing rule. Specifically, overnight funds, index funds, and exchange-traded funds, or ETFs, are not subject to these requirements. These schemes are considered more passively managed or have different structures that don't necessitate regular rebalancing. Moving on, SEBI has set a clear mandate for mutual fund schemes, except for index funds and ETFs. When the limits are breached, meaning the asset allocation drifts beyond the prescribed range, these schemes are required to rebalance within 30 business days. This ensures that the fund stays aligned with its intended risk profile and investment strategy. It's important to note that this rebalancing applies to both strategic and tactical asset allocation approaches. Whether you're planning for long-term stability or making short-term adjustments, the requirement remains the same. It keeps the portfolio aligned with your investment goals and risk appetite. Now, why is rebalancing so critical? Well, to beat inflation and preserve purchasing power, investors need to increase their investments gradually over time. Regular contributions help grow your wealth, especially when markets fluctuate. Finally, rebalancing your portfolio is a key part of this growth strategy. It involves realigning your asset allocation to maintain your desired risk level and investment objectives. By doing so, you help ensure your portfolio remains resilient and positioned for long-term success. Typically, this is implemented through regular investing in small amounts, which is often referred to as SIPs, or systematic investment plans. This approach allows investors to gradually build their investments over time without needing a large lump sum upfront. When we talk about strategic allocation, we're referring to a long-term, pre-planned approach. It's designed to be low risk and aims for steady, reliable returns. This isn't about reacting to market fluctuations, but sticking to a well-thought-out plan that aligns with your financial goals. Speaking of goals, strategic or target allocation depends heavily on your individual financial objectives and risk profile. It's about customizing your investments based on what you want to achieve and how much risk you're willing to take. Asset allocation itself is the process of dividing your investments across different asset classes, like stocks, bonds, and cash, in a way that supports your overall objectives. This diversification helps manage risk and optimize returns over time. Now, it's important to distinguish between strategic and tactical asset allocation. Strategic allocation is the long-term foundation, while tactical allocation involves making short-term adjustments based on market conditions. Both play a role in managing your portfolio effectively, but the key is understanding when and how to use each approach to stay aligned with your financial plan. Now, it's important to understand that mutual funds typically invest in financial assets like stocks and bonds, rather than in rare collectibles such as coins, art, or stamps. This focus helps keep the investments more liquid and easier to value. When we look at fixed income products, the key idea is that investors act as lenders or creditors to the issuer, whether that's a bank, a corporation, or a government. Essentially, you're providing the funds and expecting to be repaid with interest over time. On the other hand, in real estate, as well as in commodities and equities, investors are considered owners of the assets. They hold the title and have ownership rights, which can bring different benefits and risks compared to lending. So, to tie it all together, whether you're an owner or a lender in these different asset classes depends on the nature of the investment. Understanding this distinction helps clarify the roles investors play and how their returns are generated. This overall theme of asset roles and investment focus is central to grasping how mutual funds and other investment products work.